Okay, you got these things called pay option loans, okay? Actually, the FDIC endorsed pay option loans not quite 10 years ago, but they did. They thought they were a good product and explained how they're good and how they work and everything. But wow, dangerous, very dangerous, especially the way they're sold and the way it's manipulated right through origination. I saw it very often. And the big banks doing a lot of these things were, let's see, WAMU, Washington Mutual, they failed. IndyMac Bank, they failed. Countrywide, they may have done the most. Of course, IndyMac Bank CEO Michael Perry, he lied and said that we heard him did in an interview. You can just see it. I think the interview was with CNBC. That was kind of funny. Angelo Mozillo, we're good, we're clean. Loan officers who work for the company. Oh boy, they did Countrywide did a ton of those. So, Wachovia, okay, they were classic. They bought a ton of those things, and then I think another big one was Bank United. Ton of them. Well, none of them really are in their own company anymore. I mean, Wachovia's taken over by Wells Fargo and Bank United, just whatever. But these are the big ones that did a ton of these things, and it's not really explained. And the problem with the 1003, the Uniform Residential Loan Application, which is actually like an industry standard, kind of like a government document, the rate will be right on there, and you're gonna think, oh, okay, cool, that's my rate, 1.25%. That's what basically what happens if you have a pay option. You have the option to pay principal and interest. Of course, you can go above that if you wanted to. Just interest only, and the minimum payment, which would be like a credit card. You'd be paying like 1% of the balance, or 1.25% of the balance. Of course, you divide that by 12, that's what you get, because it's on a monthly basis. But you've got this minimum payment, which is the big one was 1%. Now it's like 2 whatever. Well, 1.5%, and that's your minimum payment. So the borrower's going to see this and think, oh, okay, cool. My credit's so good, and of course you don't really qualify for this unless you've got minimum 620 at the time when a ton of these things were being sold, or you got to get a 700, and then of course you wouldn't have as much of a jump in the actual rate, the actual rate. So you're going to see on the front page of your application what this actual rate is. Okay. Oh, cool, 1.25. And you probably got the advertisement in the mail with the little, squiggly line and stars all over. You got good credit and you qualify for this and everything, and you call that loan officer or whatever. And great, you're gonna get that rate. That's your payment. And they'll even show you the payment. This is a problem with HUD. I think it would be HUD, it would be the agency specifically regulating this. Of course, FDIC is just off in some other world. But, you've got to be a little more honest. You got to be clear with regard to what's really going on here, okay? The rate will actually be like 7.875, 8.00%, whatever. That's what's actually, accumulating with regard to interest. That on the first page of the application is actually the minimum payment you're allowed to make. And by the way, if you do make that payment, you're gonna have, it's not just a question, maybe, possibly, you will absolutely have negative amortization. Now, for the most part, you don't want to do this. Here I am advising you. I don't work in the business anymore. But look, there's a time and place for these. I can understand. Maybe you've got a $1.5 million house and you owe like $300,000. Treat it like a little credit card. Maybe you've got a $5 million house and you want to get $1 million payout. Okay, maybe you can understand that, all right? You got a ton of equity. A lot of these banks were banking on this, Virginia, Maryland, 40% increases, in value. You have to kind of, that kind of cyclical market, you're going to have, that much of a fall too. But, and then of course you got like this big one, which was called, I think it was called Home Equity of America. Fifth Third Bank. These crooks would put the home equity line of credit right behind it from 80%. So they put a 20% right behind it. Now gorgeous to 100%. And here's the problem. If you get to 115% in some of these things, I think it was, you had to read the fine print of this, of course, somewhere in a note or something, I don't know. Of course, as the loan officers, we never get to see any of those documents. All we do is originate the thing with the application, and in some instances we'll get into the good faith estimate and we'll be able to review a little bit of the actual truth in lending document, on there, and put down if they have to, credit and disability insurance, or they have to have property insurance. We click that little box, but you are going to default if you go to 115% on that. If you keep, neg-amming and you get to the point whereby you got, just hypothetically, you got $100,000, total CLTV. Well, now your balance is up to 115. Default. And they'll just go and try to take that. And they don't care because they can go ahead and file a claim with their mortgage insurance company and hardly lose any money on it anyway. But the pay options are just filthy the way they sell these things. I mean, the loan officers get you on the hook. Oh no, you get that rate. That is the rate. Yes, that is the 1.5. That's the rate. Well, what's this over here? That the 7 point. Well, that's just this LIBOR index. Don't worry about that. It's it's overnight banking. It's rate. You don't need to worry about that. You're a borrower. It's this whole trust thing. You see what I'm saying? We build this trust. It's all the time. Everywhere. And law enforcement, and they say, well, it's just bad business. Seriously, that's what they say, for the most part. But hey, well, you signed those papers. Well, yeah, you signed those papers. Did I not press that button that says I agree to the terms of this on Real One Player, or now I'm reading this, Adobe Acrobat Reader, and I downloaded that? Or I have this Microsoft Windows program and I'm using that on my computer, and I agree to the terms of using the gas station's pumps. You gotta read the terms of that stuff. You have a credit card agreement. Well, just don't worry about the trust issue. You signed those papers. You gotta read the papers. Paper. You signed. And you said you're okay with the rate going up, crazy numbers and all that stuff. Oh, well, the rate went down on you. It's just the last few years rates have gone down, so you're fine. But you said this. Don't worry about what I said. You signed those papers. Forget trust. Doesn't matter. Well, Uniform Commercial Code does acknowledge trust and verbal contracts. And yet, of course, the banks want to try to bank on the whole issue of UCC says this and that and everything, and they don't want to use what UCC really says. Uniform Commercial Codes, all over the country, they use that pretty much everywhere. It's uniform. Most states have adopted it. That's just one little example, but it's outrageous, people.